Hello, California, and welcome to this week's edition of Your Financial Compass, the show dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and I'm joined by two financial advisors from Bulman Wealth Group. We have Scott and Shawn McAmoyle. We've got a really great show for you today. The title of this episode is Mind Over Money, Mastering the Psychology of Investing. This is going to be really informative and really helpful no matter where you might be in your retirement journey. Scott, Shawn, what a fun show. Thanks for putting this together. This is important information to talk about.
I love this topic.
Yeah, Shawn, what's Morgan Housel wrote a book, behavioral finance book. It's excellent.
Psychology Money.
Psychology Money, that's it. I like it so much I don't remember the title. Right. But this show is heavily influenced by that.
Yeah. Yes. Well, and as I shared with you before the show, when I used to travel nationwide as a financial educator, we actually presented an entire seminar presentation on this subject matter. It's so crucial. I think a lot of folks don't realize that they have a relationship with money. You know, whether they realize it or not, you have one, and how you think about money can really influence your decisions. But even more than that, there's a lot of psychological stuff at play that a lot of folks aren't even aware of that can influence your investing and your retirement success.
Yeah, I mean, colleges have, they're offering PhDs in behavioral finance. And
it's really become recognized as a thing. Like
it really is.
And like you said, I think sometimes how experiences we had growing up, how our parents were. We have a lot of clients whose parents grew up in the Great Depression, so they have a certain way they view money, and that psychological element of it's going to run out, or I need to spend it all now, or I'm going to run out, or I can't spend a dime because I'm going to run out.
Right.
You said a few minutes ago we have a relationship with money. Most of the time, it's not a good one, let's be honest. So I think if we take a step back and realize that it's not this horrible thing, if we kind of view it as like energy coming through our hands, it doesn't have to be this evil.
For sure.
Sometimes it's portrayed as evil. So in understanding why we view it that way, I think it gives us a little bit of clarity on like, I'm not the only one that sees it this way.
Right. Well, and behavioral finance rather, can really help shed some light on why we do the things that we do. And I think that's why it's really important to have this conversation today. So as we talk about mastering the psychology of investing, let's start with how our brains handle money. And right off the bat, I think it's important for folks to understand we are hardwired to survive, not necessarily to invest as human beings, right? So let's talk about that. Where does that concept come from that we are hardwired to survive?
I think it comes from just the way that we've evolution and been kind of conditioned to this point.
Saber-toothed
when Shawn rode in on a saber-toothed tiger, I was on a mammoth. He's outside waiting. But like you said, I think that's where it comes back to. Some people are really good with investing. They have that discipline, and they can just really, it's baked into them. And some, we're asking them to donate blood every day because it seems so contrary to their evolutionary wiring that, because as you said, we're not built to do that. It takes discipline. That's why so many people are bad with money, because they don't like that idea of the immediate gratification. If you save money, say you're 40, you save money into a Roth IRA, you're not touching that for 20 years. That's not fun in many instances, as opposed to like, wow, I got a big paycheck, I'm going to go blow it all. So it's at the end of the day, I think saving and continued disciplined saving is very contrary to how we're wired.
For sure. Well, and we have some hard wiring in us to survive, right? So it's that fight or flight, it's fear and greed. Let's talk about some of those emotions and how that comes into play.
There's probably three dominant emotions that come into play when it comes to investing, and it's fear, greed, and overconfidence. And I think fear's we understand that. I mean, studies show that we feel 3 times the pain for a loss than we do for the joy of a gain. And so, and again, going back to, surviving on the plains, fear was a good thing, right?
Yeah, it protected us.
It protected us. So that is so deeply ingrained into what we do. The second is greed, this idea of chasing returns or doing something for the quick buck. And the other thing, I have a teenage son, and so the fear of missing out, FOMO, is a big driver, right? But it affects us as investors too.
Oh, it does.
When we hear our friends got into NVIDIA early on and made a killing, we want to get in on some of that too, and it forces us to make or could cause us to make some bad investment decisions. And then finally, overconfidence. Over time, we believe we are smarter than everyone else or smarter than the market, that we can beat the market. And I think one statistic that brings this home is a study was done, and 90% of the people polled felt that they were above average driver.
Yes.
And if you look at Scott's car,
That was a good
That's
one,
why
Shawn.
I wrote a
That was a
mammoth
good
here,
one.
because I can't drive anymore.
If you're new to us, Scott ribs Shawn all the time. Shawn, I applaud you. High five on
Yeah,
that.
Shawn
Anyway,
got me back.
keep
This is
going.
his last time on set, so say bye.
No, but talk about that overconfidence, right? So 90% of people thought they were really good drivers. And what did the study actually show?
well,
That Shawn's
we
a
all
bad
think
driver.
we're above average
Exactly,
investors,
and you
right?
get-
That
right,
we can beat the market, or we can
Yes.
spot trends when
Yeah.
there's nothing there.
Yeah.
On that note, it's proven that investing is more about patience and discipline and saving consistently. It's not about IQ. Every blue moon you get lucky, and Shawn bought Enron in 1999. That backfired, but it's about patience and discipline. Warren Buffett, super smart guy, but he started investing at 10. He should have a lot of money if he stayed with it, and he did, and he's a billionaire. So I think we get misinformed in thinking, oh, I got to pick at the right time, or I missed
Yes.
that one.
Yep.
You just consistently save, and guess what? You will come out ahead. So it's just it's like going to the gym. You don't go to the gym once, have an awesome workout, and you're magically
All fit and
Arnold
ripped and toned,
Schwarzenegger. It's
right?
like you
Yep.
have to go every day, and you don't notice it on the day-to-day. And then one day you look like, wow, I've been saving all these years. I got $2 million. Guess I did something right, and I picked 3 funds. I didn't have all the hot stocks. So
Well, and that's you bring up a good point. That whole FOMO, that jumping in and out of the stock market, that running after the next hot thing, if you will, right? Studies show again that damages your returns rather than if you just stay consistent and remain invested. That makes all the difference.
I think the theme here is that I think we all agree that humans are irrational, right? So if we know that, if we can acknowledge that, and we can know that up front, then we can address it and confront it. When we build plans, we can build plans on the assumption that our clients are going to be affected by emotions and are going to be affected by deeply wired fear and overconfidence at times, and we can plan and guide around that.
Yeah, for sure. So how do you help your clients master the psychology of investing? Obviously, you are aware of these things. You see it day in and day out. How do you help people when, they come in to meet with you and maybe they're prone to falling into some of these traps from a behavior standpoint?
sometimes they just need to hear it from a different person. Like, well, my brother said I need to be investing in this, or my wife gets mad at me because I keep investing in this. Sometimes when it's someone that is not related to you, and that does this for a living, we explain all the contours of it and the nuances of it. You kind of see it in a different light. Give yourself a little grace. And maybe you're not at that point. You're like, I got all this money in this 401k. I got $1 million. I don't know what to do with it. I don't know how I got it, but I need to know how to make sure I don't lose it. Any of those questions are valid questions or rational questions, and you can call the number below. We'll do what we call a complimentary financial compass review. We'll have a discussion about it, what it means for you. We can take tests to see what your risk score is. Are you taking enough risk, too much? Is your current portfolio too aggressive or not? And shed some light on it. Sometimes we've never even stopped to look. We just threw the money in and it grew, and that's nice, but are we doing everything in the most efficient way? So call the number below. We'll have a conversation, and we'll answer any of the questions that you have in regards to finance, let alone the psychological elements of it.
Yes, for sure. Well, Scott, Shawn, thank you so much. I know we've got a lot more to get into, but to our viewers at home, if this is resonating with you, if you would like some help with your financial situation, we encourage you to reach out and schedule your time to have your very own complimentary financial compass review. Now, this is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how Scott and Shawn and the team of Bulman Wealth can help and serve you. That number to call to schedule yours is 888-970-4685, or if you'd rather connect online, you can simply scan that QR code and that will get you connected as well. Stay with us. When we come back, we're going to be diving into some of the common biases that, if left unchecked, can sabotage your financial future. Stay with us to find out what those are and how you can avoid making these same mistakes.
I became a financial advisor coming out of the tough times of the tech bubble in the late 90s, early 2000s. Moved to California, uprooted my life, changed everything, and then 9/11 happened the first week in this industry. I was prepared already to help people from tough times coming out of the tech bubble, but what we didn't expect is there were 3 years in a row when I started of the market dropping. That really impacted my whole career. It crafted and created how we manage money. We don't want our clients to ever lose like that, and so everything we do is built on protection. The goal of our practice and the people that we meet with is to remove the fear and uncertainty that we all face, and it goes back to those first years in the market.
I was a sportscaster on television. I grew up in Flint, Michigan. In TV, you bounce around, and went to Mississippi and worked at the NBC station there and covered, college football's big, NFL's big, all that stuff. And a guy I knew relatively well in a different state decided to get out of TV, and in this opportunity I always enjoyed finance and money, and it seemed really exciting. I like to communicate to folks and feel like I can communicate well. It was such a fresh, kind of different career than what I was used to that it was exciting.
We go into every meeting with no place to get. We're there to meet with you, to discover your needs, find out where you are at that point, and how we can help you build and craft that plan for the future.
Welcome back. You're watching Your Financial Compass, brought to you by the team of Bulman Wealth Group. I'm Kristen Oakley here with both financial advisors Scott and Shawn, and we're so glad you're joining us today. If you're just tuning in, today's episode is all about mind over money. We are peeling back the curtain on mastering the psychology of investing. This area of behavioral finance, as you guys said, has really boomed a lot. I think it's really helpful for folks to understand, especially to understand the potential biases and mental traps that can sabotage you and your financial success. So that's what we want to talk about now, because we want to help you avoid making these common mistakes and falling into these mental traps. So we've got a whole list here. You guys ready to go through them?
Let's do it.
No.
Okay. Well, ready or not, here we come. All right.
So be it.
So first up, Shawn, describe loss aversion.
Well, we talked about the fear of loss and how painful it is. In fact, it's more painful than the joy of a gain. And that is so deeply wired, and it really protected us, keeps us safe in many cases, but it can paralyze us from making good investment decisions. The most practical example is it can cause people to sell their investments that are doing well too soon. Because they're afraid it's going to go down,
right?
So they want to, take things off the table, which can be a fair action. But what it can also do is cause people to hold on to their investments that haven't done well too long. They feel like I have to wait until it gets back up to where it was before I can move on, before I can make another decision, before I could select an advisor that may be better for me. I need to wait until my portfolio gets back up to where it was. So it really can paralyze people, and they have to recognize it and fight through that to make probably better decisions for their financial life.
And what Shawn was just referencing is kind of what we call confirmation bias, which is rampant everywhere, let alone finance. But really what that is we seek out information that supports what we already believe. It's like we get into an echo chamber as you need to have this, or as Shawn said, you hold on to a stock longer than you need to. It's like, I love baseball. If you're a manager and the relief pitcher's getting shelled, it's time to pull them.
Right.
Life is short. So you can't just hold on for the sake of it, trying to prove something. No one wants to admit they're wrong. Sometimes you have to with finances, or maybe you should have started saving earlier or get rid of that one. But this particular holding, but the point is, confirmation bias can be one of our worst enemies in various instances.
Yes. Next up on the list, recency bias. Now, this is a big one, isn't it?
And we tend to go through this quite often. It's when something happens in the market, a black swan event, we've talked about those before. Something happens where the market goes down, some external event affects the market. We tend to think what's happening now, being recent, will continue on for a much longer period. And therefore, I'm paralyzed. I can't make good decisions because the market is down now, and it's going to stay down for a really long time.
Right.
And therefore, I can't make any decisions. They're making all their decisions on what's happening right now, as opposed to taking a step back, understanding the overall trends of the market, which are lower left to the upper right. Corrections happen about once every 3-4 years. That means the market goes down 20%. But on average, it recovers in about 335 days on average, so less than a year. And we build that into our plan to help really kind of fight through that.
For
What's
sure.
called recency bias.
Yeah, as you were talking, Shawn, too, the opposite I think is true. A lot of folks were lulled to sleep when we went through the longest bull run market, 13 years,
Yeah.
right?
Yeah.
And assuming that's going to continue. And again, it brings home the point that past performance does not guarantee future results, right?
You can't time the market.
No, for sure not.
Definitely not.
Well, next up on the list, and I feel like when I read this, all I hear is moo, herd mentality.
Yeah, well,
right?
So herd mentality is exactly what it states. It's like following the crowd or what's cool, like Shawn with the pocket square.
This is for your tears. This is because I know you cry every show.
Shawn, you were
It
just
is,
bringing
yeah,
it today.
Shawn's
I
on fire.
love
He
it.
had 9 cups of coffee, and that actually isn't a joke. But like I think of an instance. I remember back, it was around November, Thanksgiving time of 2021 when everyone's cousin or my nephew said, you need to buy crypto, blah, blah, blah. And it just, this person who lives in their mom's basement is the one that you want to take the financial advice from. So we can't, the next big thing ain't always the next big thing because next week is the next big thing. And the old next big thing, now I'm tongue-tied. But point is, herd mentality, we have to stick to our thing in terms of what our plan is or understanding what it is and not get caught up in the noise. Well, so-and-so, I need to do this. Well, have you ever really sat down to see the ramifications of it? I've had a lot of people over the years ask about cryptocurrency, and if you have to ask, you probably don't need it. I don't need to go on a diatribe there, but just because it works for them doesn't mean it's going to work for you. Or maybe you don't need that. So try to avoid the herd mentality.
Yeah, for sure. And again, we are such creatures of that herd mentality. It's very easy to get sucked into that.
I think of the famous Warren Buffett quote, to be greedy when others are fearful and be fearful when others are greedy, right? It's to be,
Go against the flow in that way, right?
Yeah, be a contrarian sometimes.
For sure. And then the last one we have on the list we want to talk about today is anchoring. This is a fascinating one. Talk about it.
Well, we get fixated on a point of reference or a point of time, and we just can't get ourselves off of what we're fixated on. And to bring it right back to investing, let's say you have a stock, XYZ stock, and it was at 100 at one point. So that's your anchor. You think, well, it was 100, so it's gonna get back to 100. Now it's at 50. So you won't sell it until it gets back to 100 because that's your anchored reference point. Or can also be just as damaging. It was 100, it's now 50, and you're thinking, I'm going to buy it now because it was 100, therefore it's got to go back to 100 without really looking at the fundamentals of the investment.
For sure. I've also seen this with home sales, right? You know, your home used to be worth X and now it's down here, but you want to wait till it gets back to here. I've seen family members make that decision because of an anchoring bias, and it did not always end out, well for them. So that can happen. Yep. Well, seriously, recognizing these biases can really help people pause and think critically before making financial decisions. But I think part of the issue is we are often too close to our own stuff. And this is where you guys come in. You see all these things, you work with hundreds of people. Being able to be independent, be objective, you're able to help folks overcome these biases, right? And make positive decisions for themselves.
Right. That's why we really encourage people that if you're sitting at home and you're probably thinking they're speaking to me. I am that. I've got anchor bias, or I've got recency bias, or I'm paralyzed right now because I'm so fear of a loss. I need to talk to somebody. Wherever you are in your journey, we meet you where you are. Give us a call. You'll get a free, complimentary, no obligation financial compass review. We'll talk about everything that's going on in your financial life and give you a path forward to help recognize some of these biases and create a plan that's going to help you be successful financially.
Wonderful. Shawn, Scott, thank you so much. That number to call to schedule your complimentary financial compass review is 888-970-4685. Or again, you're also welcome to scan that QR code and that will get you connected as well. We'll be back with more on this important conversation of mind over money right after this.
After college, I spent 8 years active duty as an Army officer, as a captain in the Army. And I was really driven by this idea of service and serving something bigger than myself. And when I got out of the military, it was an easy transition to financial services as a financial advisor. There was a firm that was looking for military officers who had just gotten out. They had done a study, and the people that served in the military tended to do well in financial services. And once I got into it, I just really fell in love with not only working with clients, but building portfolios, the strategic part. Just like in the military, in a military operation, you're here today and later you want to get to this destination. How are you going to get there safely? Planning all the logistics, the danger areas, planning around those. They just related to each other in a way that just made sense for me. And this feeling of serving clients, serving others that's bigger than myself became kind of my calling, just as serving in the military was my calling.
As Americans, we strive for better. Better house, better career, to better the lives of our kids. Better's become the American way. But when it comes to your retirement, what does better mean to you? More income, flexible lifestyle, better solutions? A better retirement begins with a plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity. Plan for better.
Well, welcome back to Your Financial Compass, where today financial advisors Scott and Shawn from Bulman Wealth Group and I have been discussing this concept of mind over money, the psychology behind investing. And we've talked about all the different biases, all the mental traps that folks can fall into. And before the break, you guys are doing a great job of explaining what it is you can do for folks to help people successfully navigate through this behavioral finance component. Let's get really practical. How do you help people not just invest better, but think better about their money?
I think a big part of it, if not the biggest part, is creating an actual plan in terms of, say, for example, a retirement income plan. Where's the money coming from? How much do we need? When are we going to get it? How much are we paying taxes? What kind of rate of return do we need to get? And here's the thing with a plan, though. Behavioral finance says the only thing you can assume with plans are that plans change. So what that means is you create this plan, or we help you create this plan. It doesn't have to be static. It's not going to be static. Something's going to happen. You get a higher return than you thought, or kids are more expensive than you thought, or grandkids are more expensive, or you're going to move, or any number of things. So assuming that the plan's going to change, we're always editing it and looking at it, talking through it, and seeing how that fits. But as long as you know you have a plan and the plan's going to change over time, and we're going to modify it for you, I think it can help us make not as many irrational decisions that we might typically make based off behavioral finance. So we almost protect ourselves from, or the plan helps us save ourselves from poor choices.
For sure. And I think having a plan also helps folks walk through the what if scenarios, right? So talk about how you build that in, because I think that's what keeps people up at night, right? Is what if this happens? What if that happens? But you're able to help actually show them scenarios so that they can know what could happen.
Right. Well, as Scott talked about, the plan is dynamic. As the world changes, life changes, market conditions change. We need to adapt the plan accordingly. But I think we're meeting with our clients frequently, and one of the things we do is go through this what if exercise. Because what if something happens somewhere in the world, a big geopolitical event, a war happens, an oil crisis, another pandemic. What if that happens, the market goes down 30, 40, even 50%? How are you going to feel? How are we going to react? And so I think part of handling emotions is just being prepared for the unexpected, knowing it's going to be an emotional event. We're going to feel anxiety and stress. So let's talk about it now when we're not going through it, and decide what's going to be our best course of action. Right. I think that gives people a lot of peace of mind.
And on that note, as Shawn was saying, is just accepting market volatility when it comes to investments.
It's part of it, right?
It is part of it. If you've been investing for years, you've seen it in any number of ways, the good and the bad. And one of the big takeaways with behavioral finance is, when is it enough? Like, well, as we say, we create a plan for someone, and the plan is, hey, for everything to work fine, you need to earn a 5% rate of return. Well, hey, that's nice to know. Why would you shoot for a 15% rate of return and take all that risk when you could potentially jeopardize everything?
When all you need is 5%.
When all you need is 5.
Yeah.
Okay, let's shoot for 7 or 8, but why would you shoot for 15? Why would you take more risk than you need? So it's understanding when is enough. Like, when is it enough? And only you can answer that. But sometimes you have to be working with someone to say, hey, why would you take more risk than you need to?
Right. No, that's very, very wise. There's also this mindset shift, and you talk about the difference between being an investor versus a trader. Right. Talk about that.
Two distinct mindsets and actions, and traders are looking for the short-term wins, and it's almost an adrenaline junkie, right? There's nothing more satisfying than buying something low and selling it high, and then doing it again. Versus an investor, it takes a lot more discipline, requires putting systems in place to be focused on the long-term goal. I think you can have both. I mean, it's not one or the other, and I think that's, as advisors, what we do is really understand where clients are, where they're coming from, what's been their past experiences, what do they enjoy. In many cases, we build a solid financial plan for the long term, but we recommend to a client, why don't you carve out an account that can be your trading account, and you can satisfy that need to be a part of the market in that way. But I think you can put systems in place to, for example, sell high and buy low through dollar cost averaging, through rebalancing.
Yes, yep.
And those are ways that we satisfy kind of that emotional bias need, but stay focused on the long-term plan.
And we said this earlier in the show, and I love this phrase. Generally, the most successful investors aren't the smartest ones. They're the ones that have been doing it for the longest time. It's not the crash diet, Atkins diet, I lost 20 pounds. Yeah, and then you put it back on a month later.
And then some, right?
And then, I put on 30 pounds. It's like the ones that just chip away and chip away and chip away. So it's that discipline. And once you start it, it becomes a habit. Guess what? It becomes easier to do that. But it's understanding, giving ourselves a little grace, but also some accountability too.
Yeah, for sure. And I know that you are excited to connect with more folks as a result of today's show, and you could become the accountability partner for more folks watching, right?
Certainly.
Well, Scott, Shawn, thank you so much, and thank you for joining us for this informative and helpful conversation. We encourage you to reach out to the team of Bulman Wealth Group to schedule your complimentary financial compass review. 888-970-4685 is that number to call, or again, you're welcome to scan that QR code and that will get you connected as well. Thank you so much for watching, and we look forward to being back with you next time here on Your Financial Compass.